Hi there, thanks for tuning in. Today we're going to be doing an analysis and valuation of Flexsteel Industries Inc. They're a furniture manufacturing company, and if you've bought pieces of furniture in the US, you may have seen their name pop up. Essentially, they have a couple of brands such as Flexsteel, Flex, Zecliner, Charisma, and Homestyles. They're one of the top 10 US furniture manufacturers, and they essentially do a lot of e-commerce nowadays, although you can find them at some retail chains and big box stores. Essentially, here are the e-tailers that they sell at, such as Amazon, Wayfair, and the Home Depot, big box stores such as Costco and Home Goods, and even more retail stores. And they seem to have a growing revenue, although you can see there is some cyclicality here. If you look at this shape, even pre COVID 19, you can see that there were these ups and downs. Their performance, for example, between 2015 and 2019 showed that it was pretty much almost flat in those years, right? Despite the fact that it grew a little bit before. So they're a company that has had overall growing revenue, but with a little bit of struggles, right? And they seem to be facing a few headwinds due to economic uncertainty, waning consumer demand for durable goods, and high inventory levels at retail. This is something that is happening for the whole industry. The furniture industry had a lot of inventory because there was a lot of demand in 2021 and some of 2022. Then all of a sudden, they see themselves stuck with all this inventory. And that is an issue, especially because getting rid of inventory generally also requires you to sell it at a discount, for example, especially if it's seasonal items, for example, that may not be as desired, or items that are no longer in fashion, right? So the fact is that these levels of inventory, this economic uncertainty, well, it's going to hit the furniture industry. So they're telling us that the industry in the near term is not going to necessarily do amazingly, right? They're saying there's going to be a growth of 0.3% for the furniture industry. Although they do say that the overall furniture market is expected to grow, maybe from 21 to 23 and 24 it's not going to grow that much, but overall the pie is growing, right? They're not fighting for a pie that will stay the same size or that will shrink. The pie is overall growing, although they do have a lot of competitors here. And this is kind of small, but you can see Flexsteel over here in a retail brand that is best in class or quality. And they say that the industry is very fragmented. However, it's it's important to note that there's a lot of competitors. This is an industry with a lot of people in it. This is an industry where there's a lot of choices as a consumer. So this is something that also affects the overall outlook for Flexsteel Industries themselves. Now, they're saying that the way they're going to allocate capital in the short term is to repay debt, reinvest for growth, and maintain their dividend, while in the long term, they're going to keep reinvesting for growth, they're going to acquire other companies perhaps, grow their dividend, and repurchase shares. And here you see their capital expenditures used to be pretty massive and have since dropped off a little bit. And their dividends and share repurchases, well, you can see this growing dividend here that they cut after the crash in COVID 19. Of course, they were no longer making money there, but they have been repurchasing shares at a very, very accelerated pace. All of a sudden, they hadn't repurchased shares before. All of a sudden, they start repurchasing shares at these massive amounts. However, for fiscal year 23, we see that both of these items are going to be greatly reduced. So that's important. If you're an investor that's looking at past numbers, it's also important to see their guidance for the future in these kinds of things. If you're buying just for the dividend or just for the share repurchases, you have to see that past performance does not guarantee future results. Now, their financial objectives, they show us here that their net sales are going, well, they give it a massive range actually, between 390 million and 485 million. This is a pretty massive range, which also shows that they're not really committing to anything. They're saying, if there's very bad results because these 390 million would be less than they made last year, well, they're going to be like, okay, well, this was within our prediction. So it's a little non-committal for my taste, but whatever. And then in the midterm, they say this is going to grow, and the long-term aspiration is that with acquisitions, it's going to be a revenue of 750 million. And their gross margins right now are 17 to 19%. Yeah, this is in line with their present, but they want to improve that all the way to 23%, as well as their operating income margin, which 2 to 4%, yeah, that's pretty much in line with what it is right now, but they want to improve it to 8%, right? This is important. They're saying they are putting stress in this, right? And, however, I will say that net income margins are missing, which is important, and free cash flow margins are missing. And you'll see that when companies don't have free cash flow, they talk about revenue, which they're talking about here, and operating income. When companies don't have that, they talk about the total addressable market. So it is kind of not great to see free cash flow missing here, but we'll see why. So here's their income statement. Essentially, from 2020 to 2022, their total revenue has grown, and their margins are pretty competent for a company that has to manufacture all the stuff they make. Obviously, it costs them to sell extra units of the stuff, but their operating income, well, it seems to be present here, even though from 21 to 22 it greatly reduced. And their net income, well, they had a tiny bit of net income in 22. Obviously, 21 was an outlier year, and so was 2020, really. Of course, this is a very temporary thing that happened in 2020. But this serves to stress that this company is volatile. This company will be affected by things in the economy. Euphoria will make a lot of people buy furniture. If all of a sudden people have these cash injections, a lot of people will be buying items like that. But times of economic crisis may make people not buy a lot, and thus they may see an operating loss or definitely a net income loss, right? So this is important to see. And I want to talk about the cash flow statement. Now, free cash flow is, by definition, cash from operations minus capital expenditures, which you can see over here. However, you'll see that they had negative cash from operations in 2021. Why was this? Well, their inventories. They had such a huge change in inventories. These $90 million, negative $90 million you see, is what they paid in order to acquire these inventories, and they couldn't get rid of them, which is a massive hit to their cash from operations. And that means that they're less flexible with what they can do. They can't use that free cash flow to pay a dividend, to pay down debt, to repurchase shares, or to just reinvest in the business or acquire other businesses, right? So this is something that hit them hard. It hit them really hard. And declining or increasing inventories and these unsold inventories is something that you have to note whenever you're investing in a retail company. And right now they've gotten rid of some inventories, but some still remain, and that's very important. You'll also see that their stock-based compensation is a decent chunk of their cash from operations. So that's also important to note. If you're doing evaluations such as discounted cash flow, don't include stock-based compensation. That's an expense. It literally says it here, expense. It shouldn't be part of cash from operations. Other things that are important, their dividends paid. You'll see that they cut it significantly from 2020 to 2021. This is probably fair, honestly. As much as investors don't like it, they will need that money, especially when the margins are so tight with free cash flow, with operating margins, you know? And they did some share repurchases, of course, and they really are dedicating a lot of cash to that, but it seems like there's going to be less, and this is fine. If this allows them to improve their operations internally, well, it's important to note that even though investors won't be seeing that return directly, they may be seeing it indirectly if the company is getting leaner and better. Now, I cannot really value this company using a discounted cash flow. Again, you see here that their free cash flow is negative in 21, and in 2020 it was also kind of strange, and now there's all this volatility, you know, and they have had years before where free cash flow is negative. So I'm not going to do that. Instead, I'm going to use EV to EBITDA. And this is a pretty good way to value companies that don't really have consistent free cash flow that you can use for discounted cash flow. And first, I'm comparing it relative to itself. I got this from financecharts.com. Pretty simple. And relative to itself, right now it's trading at about 7.8 times EV to EBITDA. And relative to itself, it seems to be sort of on the lower end. But you'll notice that they have had negative EBITDA before. So this ratio has been negative before, and it has been pretty low before, you know? So it's not to say that it's impossible for it to go lower, right? And I want to put things in context. The context is comparing it to its peers, right? So the EV to EBITDA that it has is 7.8x. The forward EV to EBITDA is 5.7x. But you would either need a significant expansion of EBITDA or a significant drop down in the value of the share price. So I don't know about this, but you'll see there's all these companies that you can compare it with. A lot of them have larger market caps. This is a smaller cap company, but the industry median EV to EBITDA is 7.3x. What does this mean? It means that the industry as a whole, on average, has a lower EV to EBITDA in this moment, in this current economy. So even though relative to itself, it's trading at a lower EV to EBITDA, it doesn't mean that it's cheap, especially when compared to its peers. It means that maybe the whole industry is undergoing a moment where it is valued as a whole with lower EV to EBITDA. And if I were to invest in a furniture company, I would look at the furniture company with the best margins, because that would make it withstand economic downturns better, and also with lower EV to EBITDA. That doesn't mean it's the best one, but it does mean that it's more likely to survive and to do well in times of economic downturn or less demand in general. So Flexsteel Industries right now is trading at $19.31. It has a market cap of basically $100 million. It has a dividend yield of 3% and a PE ratio of almost 24. So as a PE ratio, it also doesn't necessarily look undervalued, even though this downturn may tell you something else, right? In the last 5 years, it's gone down over 50%. But it's important to put things in context, so let's do that. Flexsteel may look undervalued when compared to its own historical performance, but it may not be relative to its own sector, especially the whole sector is expected to not perform that great. The furniture industry has many competitors and is sensitive to economic downturns. This increases the overall risk you're taking when you are investing in Flexsteel, right? You're investing in a company that does not really have a large moat. I, as a consumer, can choose to buy any furniture from any company. And also, I, as a consumer, if my income is cut, right? If there's a recession and all of a sudden I lose a job, big pieces of furniture is probably something I will cut. So they are very sensitive to that. The free cash flow is very volatile, and a good chunk of it is going to be committed to dividends, especially in the future. There's a price to buy it at, but the risk reward may just not be here at the moment, especially if you're focusing on risk first, which is what I recommend. So this may be a little harsh, but I hope that you learn something from this valuation. It's a little different from the one I do for other companies, but if there are other companies you want me to look at, please comment down below. I would be very interested in reading all your comments and seeing what you bring up. And with that said, I won't take any more of your time. Just remember to like and subscribe if you like this video. So with that said, please have a great rest of your day.